So we'll begin today's event. First of all, my name is Oded Orgil. For those of you who don't know me, I am president of the Canada-Israel Chamber of Commerce, and I'm very happy to have, and I'm very excited about today's event. For those of you who don't know, the purpose of the Chamber is we are a bilateral organization between Canada and Israel with our goal to promote bilateral trade and increase that between Canada and Israel, two great democracies in our world. Often we'll have a number of events that often focus on events that go on in Israel and related directly to Canada and Israel. But today, given the appetite from some of our membership base, we're very excited to have an opportunity to hear about alternative investments that are available to our membership base. Our featured guests today are Sebastian de Kloet, who is the Senior Vice President of Marketing at Red Cloud Securities. The Red Cloud Securities is a resource-focused regulated dealer in Canada, offering a wide breadth of advisory, investment banking, research, and distribution services. Its affiliate, Red Cloud Financial Services, is a globally oriented, resource-focused financial services platform supporting clients through an extensive array of corporate access services, including advisory, marketing, and media. Sebastian is here today to talk to us something very timely, flow-through shares, which people can hear about. It again can be a very solid investment as well as provide some unique tax advantage opportunities for clients. Atul Tiwari is the CEO of Kloet Wine Investment. Atul joins us as the representative from Kloet Wine, which is a global leader in fine wine collection and investment management. They are on a mission to make investing in wine as enjoyable and rewarding as the wine itself. They seek to access rare, high quality, sought after investment grades wine and present those to wine lovers as an opportunity to invest as well as enjoy over the long term. And finally, Chad Robinson, who is the president of Align Capital Mortgage. Chad, as president and Align Capital, they provide creative mortgage solutions to a wide variety of borrowers in Ontario and trying to provide investors stability in a very volatile investment world. Real estate, as many of you know, is one of the oldest investment asset classes in the world, and major fortunes have been built on the foundation of real estate. So first of all, thank you all for joining us. What we'll do is I think I'm going to turn it over to Sebastian for about an 8 to 10 minute presentation, and then on to Atul and then Chad, and then we'll open it up for Q&A. So Sebastian, without further ado, thank you today, and over to you.
Thank you very much for having me, and thank you to everybody that's on the line that's taken some time today in their busy schedules to hear a little bit about alternative investments. So I'm going to share my screen here and give you a little bit on Red Cloud and myself, and then I'll jump into reasons why flow-through is an interesting investment class to defer your taxes so that you can go and make investments in wine and other alternatives with Atul and Chad here. So Red Cloud's been around for about 10 years. We've only ever worked in the mining space, and that's probably because that's all we know how to do. The majority of people on our team are mining engineers, metallurgists, geologists. I'm not one of those. I'm from the financial background. I'm an economist by background. But I came and joined the team about 6 years ago and built what is now probably one of the most robust mining services platforms in the world. So everybody knows the way that a regular financial services firm is built. We are not one of those. We're the anti-regular financial services firm, if you will. Most firms, if you're a publicly traded company, they will act on your behalf to finance you and then offer a lack of support thereafter. Whereby our model has been created to offer a corporate access service where you can go and find investors in between the deal cycle that can come into the deal and bring your share price to a higher level to create less dilution. So we've got a strong distribution network. We're ideas driven. So that's our technical expertise that comes in here, as well as our banking expertise. We offer high quality research, again, only in the mining space, which I will say is probably one of our strongest traits. Our mining analyst doesn't become a tech analyst when it's hot, or a cannabis analyst. They stick in the mining industry and what they're good at. We have unique access, corporate access and media strategies. So As you know, online right now, you'll find the largest pool of investors. This kind of stuff is amazing. We love doing Zooms, and in-person meetings are great too, but it's the guy that's hiding behind his computer that is the one coming into the market and making the incremental buys these days. So again, first section is Red Cloud Financial Services. We came onto the market. Nobody really knew who we were, Red Cloud Securities rather. And we've quickly gone and jumped a whole bunch of these reputable names that you see here as far as led financings in the mining space. So we're very, very proud of this, and we continue to go and leapfrog some of these big names. As you can see, every name on here is a mining name. Some you may recognize. Our latest and largest bought deal private placement was Global Atomic, which is a uranium company in Niger. And we prefer to invest in alongside our clients. So if you're investing in a deal, the likelihood is that Red Cloud has some scratch in it as well. We also act as an independent advisor for a lot of firms. So you can see some of the deals that we did here, but I'll let you go through that at your leisure. These are the names under coverage. So we cover companies that are typically a little bit down market from the BMOs or CIBCs or TDs. We like to get our feet wet in the trenches where we think the money is to be made. So that's anything from a private $3 million market cap company all the way up through the multi-billion type companies. But we like to go and help the growth and grow companies in that direction. We also offer market making, which I think is pretty obvious for everybody as to what that is. Create a increased volume and tighten the spread of these junior companies. And then the more interesting side for me anyways is the financial services side of the business, where we offer a robust network of distribution all over the world. So we'll find pockets of investors anywhere, whether it's through the Chamber of Commerce here, or whether it's through family office networks or investment advisors that offer worldwide distribution to get our clients the most eyeballs on the story. This is a little bit more about that. We do webinars, retail marketing, institutional marketing. We run our own conferences, and the list goes on and on. Here are some of our partners. Our media team is robust and offers new strategies to the investment world, including corporate video, graphic design, and a robust social media team, which has now grown out to about 10 individuals that help your geologist CEO push his company forward. Obviously, everybody needs to know what their strength is, and our strength is helping you with the things that you're not strong at. So that's where Red Cloud comes in. And then our team has been around for a very, very long time. So you can see our team is continuing to grow here. We're about 55 of us at the moment, and continuing to grow. So I'll jump off of this right now and jump a little bit into why I think flow through, especially at this time of year, is a really good investment. Sorry to all of you that now see my enlarged face. But at the end of the day, so if for those of you that don't know about flow through, it's an initiative that's been put forward by the Canadian government in order to stimulate investment within Canada. So this kind of investment can go in 3 different avenues. There's a real estate version of it, there's a oil and gas version of it, and then there's a mining and metals version of it, which is the one that I'll be focusing on today. So for example, if you are an accredited investor, so let's start there. So an accredited investor is somebody that personally makes $200,000 a year, or them and their spouse makes $300,000 a year combined, or they have $1 million of liquid assets, or they have $5 million of fixed assets. So why is this investment only available to those types of individuals? And that's sort of a question that we've been asking for a very long time, but essentially it allows the wealthy to get a little bit more wealthy by deferring their tax. So if you have a taxable income of, let's say, $100,000 or $200,000, and you were to buy $100,000 worth of flow through, your taxable income is now only $100,000 because you have invested in a mining company, for example, that is going to be spending that money in the next calendar year. So if an exploration mining company is net zero, so basically they don't make any revenue, you are flowing your revenue through, which is why it's called flow through their company, and they are spending it on your behalf, and it basically comes right off of your taxable revenue line. Now, when you sell that stock, because now you're holding stock of company X, when you sell that stock, you're taxed at a 50% capital gains. So your net is 0, and then you're taxed at 50% capital gains. So what does that mean? If you bought the stock at $1 and the stock is still at $1 when you sell it, your cost basis being 0, you're only taxed on $50,000 of your $100,000 investment. So within the private placement realm, you're able to go and purchase shares or you're able to go and roll your capital over, because there's a 4-month hold period typically on private placements in Canada. So if you're able to roll your money over 3 times, that means that your $100,000 can have $300,000 worth of leverage, because you're rolling it over and you're getting a tax benefit each time. So at the end of the day, you can either push yourself into a lower tax bracket, which is obviously beneficial for everybody because you're not paying a higher tax rate, or you can push yourself down to next to no tax at all. And this is obviously a very interesting concept that a lot of people think is too good to be true. Let me tell you, it's not. If you look at all the individual mining companies or individuals on university in Toronto that have wings, Peter Monk, Pierre Lassonde, all these individuals are mining individuals that have been able to take advantage of these kinds of tax incentives, even with a charitable component associated with it, in order to go and make large charitable contributions to get their names on wings at hospitals. So with that, maybe I'll pass it back over to you, and we can have a little bit of a discussion on what this means. I know, Oded, you had mentioned that you participated in a lot of flow through in your time, and maybe we can go back and forth on what that's looked like.
Sebastian, yeah, that's great. First of all, thank you. That's a great high-level summary of both Red Cloud as well as flow through shares. I'm looking forward. I have a couple of specific questions that I would like to ask you, and we may have some that come from the audience. I would like to turn it over now to Atul for maybe something that's a little more aesthetically enjoying as opposed to talking about mining. But Atul, please, if you could tell us not only about the joys of being an investor in wine and why people should consider it for their portfolio.
Great. Thank you, Ed. And thank you to the Chamber as well for having us, and my fellow panelists. Very interesting discussion already on flow through. So yeah, why don't I'll just give you a little bit of history on myself and the company, and maybe talk a little bit about some of the investment merits of considering fine wine as a portion of your portfolio. So I myself started out as a lawyer working in corporate securities, and I like to say, I think, Oded, I saw LLB next to your name, so you're a reformed lawyer as well, just like myself. And I moved on from the corporate securities world into asset management with BMO. So I had a number of executive roles at BMO, including running Bank of Montreal's mutual fund business out of Chicago for a few years, and setting up the exchange traded fund business for BMO. From there, I went on to Vanguard, who was looking to establish an operation in Canada. So I was hired to be the first employee in Canada as the CEO, and we grew that business over 8 years. After Vanguard, I was looking for something to do that would combine some of my passions, fine wine being one of them, and asset management being another. And I knew that fine wine was an asset class that was established in Europe and in Asia, but hadn't really been created as an asset class to any great degree in North America. So with colleague Carrie Tuck, who was also with me at Vanguard, we worked on a business plan, reached out to Cult Wines in the UK, who are the global leader in the space, and we worked out a good deal to create the North American side of Cult Wines. So just a little on Cult Wines. As mentioned, its company is based in the UK. It was set up in 2007, so we've got a 14-year track record. And it was set up by our current global CEO, Tom Gearing, and his father. It has grown over those 14 years to have about, in Canadian dollars, about $340 million in fine wine assets that we look after for our clients. We have 6 offices globally, including in Shanghai and Hong Kong and New York, and obviously now Toronto, with about 80 people around the world that are working in the business. So what do? We provide a service for our clients when they onboard. We will do the know your client and suitability just like any other investment. And once we determine your risk profile and your duration of investment, we will then match that to a fine wine portfolio. And so one of the unique aspects of what we do is that as a client, you actually own the wine. So we purchase wine essentially in full case lots, because value of wine and other collectibles is enhanced as long as it's in its original casing. And we will then actively manage your portfolio for you. And since you own the wine, you always have an option to take possession of the wine rather than sell it. And what we find is 80% of our wines are resold and proceeds either reinvested or taken back by clients. And about 20% clients say, there's that case of 2000 Lafite. It's something I might want to enjoy, so I'll take possession of it rather than sell it. So that's the form in which we'll offer the investment. And then the last thing I'll just touch on is with respect to the investment merits. So fine wine is it's a classic example of supply and demand. We would estimate that about 1% of all the wine made in the world is investment grade. And that's about $4.5 billion a year of new vintages coming on. And so as time goes on, that limited supply reduces through consumption, obviously. And then the demand element is something that continues to grow as there's more wine drinkers coming onto the market, and different geographies that are may not have traditionally been wine drinkers, but are now becoming more so. And so with that demand, obviously it pushes up the price of a limited commodity. And so that's the governing principle. And then from there, when you look at the characteristics of fine wine, you'll see that they have very low correlations to the equity markets, very low volatility when compared to equities markets or even gold. And what the investment professionals call a low downside capture. So what that means is when markets go down a lot, fine wine barely moves. And so when you look at periods like 2008, the S&P 500 was down 38%, and fine wine, based on the recognized index, which is the LiveX 1000, was down 0.6%, so less than 1%. So it really provides a nice buffer in your portfolio. And the last part is you have an opportunity to earn some pretty good returns. And we have, over the 14 years of operating, have essentially returned about 12% per year on an annualized basis. So a reasonably good historical track record there as well. So I'll stop there, and I'll let you move on to, I think it'll be Chad.
Yeah, Atul, thank you. That is an excellent summary from a high level. I can already see that there's going to be some questions following up, and I have some, so definitely.
Great.
But like as you said, let's just turn it over to Chad, and Chad is going to talk a little bit about Align Capital and a more traditional, but again, an alternative, what we often call investment class in real estate. So, Chad, thank you, and I see you have a presentation, so over to you.
Perfect. Thank you so much, Oded. It's really appreciate being here. And yeah, definitely private lending and real estate in Canada is not as sexy as wines or mining or some fun stuff like that, but it's slow and steady. So I'll just jump right into it. Again, thank you very much for having Adam and I on today. It means the world to us to be part of this. The first, there we go. Of course, we have to have the big disclaimer. We're not selling securities. I'm not selling securities. If you have security-related questions, definitely Adam here is a licensed CMD, and as well are your financial professional. So very quickly about me, president of Align Mortgage Corporation. I'm second generation real estate. My mom tells a joke that as she was giving birth to me, she was writing real estate offers. So it's been in my blood since literally the day I've been born, and I love, eat, and breathe everything real estate. Adam, my partner and CEO of Align Mortgage Corporation, has been in the industry for over 30 years and has grown several mortgage investment corporations and raised over $3 billion of syndicated real estate deals. So, you know, on a really high level, we're real estate all day through and through, right to our core of our genetics. So the investment market challenges that everybody's facing these days, and both you guys, Atul and Sebastian, have touched on it, right? Interest rates right now are at an all-time low. The traditional secure kind of investments are really trending down. There's a huge amount of volatility, right, in the market, let alone the global instability, Russia, you know, on the border, and China being China, and then of course COVID, right? So COVID has also thrown in these weird volatile natures, and it's kind of neat. Atul's comment about how wine is a balance of that volatility, and so is real estate. And definitely in private lending, we're slow and steady, very methodical, very stable. And mortgages and real estate have typically been a hedge against inflation. So it's one of the exciting things about this kind of market. So real estate investing, as you mentioned, Oded, when you started, one of the foundations for most people's wealth, and you know, most of the family offices have some degree of their portfolio invested in real estate, and it helps balance out that volatility. So what is private lending? We get asked this quite often. A lot of people think they hear about private lending and they're excited and they know, okay, what is this? So at its core, it's really peer-to-peer lending. This has been going on since biblical times, you know, one person lending money to another. It's very solution-driven lending. So it's all about, we're solving somebody's problem. It could be a divorce, it could be a business opportunity, it could be flipping a property, they might be in some kind of trouble with their credit. They just don't fit the box that the bank is putting for them. And lately, everything is a box. You know, the banks, as funny as the world gets more volatile, the banks tighten down and just make more little boxes for people to fit into. And that's a great thing for companies like ours, because we're the opposite of that. We're giving flexibility to the borrowers. On the investor side, it gives great stable income. As I mentioned, it's an inflation hedge. And when done correctly, we also diversify geographically and in portfolio, first mortgages, second mortgages, different asset types, that type of thing. So we found this article that CICC put out. They did a bunch of research, and it's really timely. It just came out last week. MIEs, or mortgage investment entities, represent 8% of the total Canadian marketplace in 2022. That is a staggering number. So it's not like these are little back room or kind of off to the side little companies. We represent a major force in the Canadian real estate market. The average mortgage size is $260. Interest rate range from 6.5% to 15%. So, you know, there's a big spread, and a lot of this is first and second mortgages. That's why you see the difference. And what I really loved seeing, because it also is reflected in our book, is late payments are actually less than 1%. So there's very, very little negative late payments in this world. That's a diligence to how conservative Canadian and Canadian lending actually is. And their portfolio is actually, CMHC said this, which I was really surprised, because CMHC, you know, really doesn't want to give any positive news, but the risk of mix and MIEs is actually decreasing in 2020. So that's a really positive sign and a healthy sign for industry. So Einstein said, compound interest is the eighth wonder of the world. The comments earlier about the volatility of the TSX, we analyze this, you know, 10,000 at 7% or 10,000 at 6%, you know, for the last 15 years have beat the markets. Simple, boring, compound interest is so powerful. So what are the typical type of mortgages? First mortgages, terms run 1 to 2 years. Seconds, a little bit shorter time, but up to a year. Rates vary 6 to 10% and over 10 for seconds. We traditionally do loan to values less than 80% on firsts. Sometimes in seconds, it can get pushed higher. We typically, our fund tends to be a little bit more conservative. I don't like to go above 80% unless we have extreme situations. And currently, as you can see, under management right now, so under our whole group of companies, where our average loan to value is 61% for first and slightly lower for second mortgages at 57. So it's a really well diversified mix of mortgages. Just an example, because a lot, again, people don't realize, they say, well, why would somebody want a private mortgage? Why would somebody pay 10%? They can go to RBC and go get a mortgage at 2%. Why would anybody do that? Well, here's an example of a renovator. Property was $875,000. He had a mortgage at RBC for $450K. When you go to look at the penalty, it was some astronomical number, like $45,000 to break the mortgage. It was insane, but he needed money to do the renovations for the property. So he came, he didn't need a big mortgage. He wanted the second mortgage, it's $55,000. So 12% second. And he kept it for a year. He's paying out this year, coming up in 2022. So there's a really simple example that the math worked way better, even though to take a higher second rate than pay the penalty and redo the first mortgage. Another example, this was a power of sale. The gentleman got hit. It got triple whammy. He got divorced, COVID, and lost his job all within the same time. He got behind on his payments. And once you're in that rat wheel of getting behind your payments, it's really difficult for people to catch up. So they came to us looking for a solution. 50%, 52% loan to value. So very, very low risk, 8.5% return to the fund for that. And it was a clear exit with a refinance. Another example, small business owner who again was hit with the pandemic, and he wanted to pay off his taxes, pay outstanding debt, fix his credit score a little bit so he could refinance. Just some examples of the kind of person. This was our first mortgage at 7% that we did on here. So what is Align Mortgage Corporation? So Align Mortgage, we focus mostly on residential loans in the province of Ontario, first and second mortgages, nothing too fancy, right? Real estate, I believe real estate's boring. Boring, simple, safe. The income can be paid monthly. We also do DRIP, dividend reinvestments, and we're targeting for eligibility of all the different registered accounts, whether it's RSPs or DSPs. If it has an R in it, chances are we'll be able to invest in this through your registered accounts. So what is the opportunity? So we have two funds. We have Aligned Prime Mortgage Trust. We have a 6% target yield for that and a 65% targeted average loan to value. We're exceeding those targets right now quite substantially. And then our high yield, which focuses a little bit more on second mortgages and some smaller centers, is targeted at 8% yield. So this is where we differentiate a little bit between the two trusts, the high yield and the prime. You'll see here in the high yield, we have a slightly bigger portion of our allocation in smaller markets. So smaller markets are things like Barrie and London and Hamilton and versus Toronto and Ottawa and Kingston, some of the smaller centers. And right now we're trending over almost close to 10% for our high yield. And our prime trust is really more vanilla, downtown Toronto, downtown Ottawa properties that are really core. And we're just above our target yield at 6.29%. So competitive advantage of investing with us, we have a seasoned management team. As I mentioned, Adam and I have been living real estate our entire lives and investments. Superior risk-adjusted return. And this is the fundamental core of Align is, and why we called it Align is we want to have everybody's interest aligned. The investors, the borrowers, the brokers, us. If we're all looking for the same goals, we're helping people, we're helping our investors, we're helping our borrowers, everybody wins. It really goes to our core fundamental belief of the company. And of course, we give reporting and we're focused on underwriting. And yeah, if anybody has questions, feel free to jump in. And Adam's also on the call. I'm sure, Adam, if you're there, I don't see you on the screen anymore, but definitely say hello.
Yeah,
there we go.
Adam's there. Yeah, that's great. Well, Chad, listen, that's a great summary. Thank you very much from a high level. Just to let our audience know, if anyone has any questions, please just put those through, and we'll make sure that our presenters have it. Chad, if I can right away, since I've got you right now, I'll ask you the very first question that I just have off the top of my head. You talked about the size of the market that is now big and why people aren't or again are coming to you. Is this market growing? How do we compare perhaps to the United States? And do you see more opportunities, for investors? I mean, is there a cap? Even though 8% is a large number, is it growing?
Absolutely, it's growing hands down every year. And the reason why it's growing so much, there's twofold. Number one, the banks are becoming more and more conservative. There's a lot of homogeneity happening behind the scenes in the mortgage underwriting. There's a lot of consolidation happening. Like MCAP, for example, just came and bought up half of the mortgage lenders in Canada. And that means that the underwriting gets very similar between all the lenders. And whenever that happens, there's not as many opportunities for these clients that just don't fit the box, right? They have a divorce, they have a blip on their credit score, there's something. So it's definitely growing for that. And at the same time, the market's changing. So people are having gig economy, they're self-employed, they're not the traditional type of employment anymore. And whenever you're looking for those kind of things, the banks are, they'll take them 10 or 15 years to catch up to, to that kind of underwriting. So.
Right. No, that's perfect. Yeah, thank you very much. That's a great answer. So as I said, if anyone has any questions, please post them up. Sebastian, I'd like to come back to you if I can. You talked about some of the wonderful advantages of flow through shares and how these can be used and how people have generated tremendous wealth over the past. One thing, if you may, for our listeners who may not know, perhaps maybe talk about why is the government so generous in offering this just to this sector? I realize it, and I know the answer, but I think maybe just to give some context as to why this exists and will it go away from that perspective?
Yeah, there's every single year they try to tell us that it's going to go away, and I think you'd have an absolute backlash of individuals that would be very angry if this wasn't in existence anymore. But the main reason is, and I would say it's selfish on their part, but a gold mine, for example, when it goes into production, is going to pay them a lot more on the tax side than any individual or a group of individuals that are going to fund that gold mine ever will. So it's really going and put into place to stimulate the economy, and make use of the resources that are very much abundant in Canada. So the more investment that goes into the mining sector, and I think that everybody here can agree that Canada has been built on robust resource sector over the years. So that sector comes around, once every 10 years for 10 years. And I've worked in the industry for about 10 years and the last 2 have been really good. And the 8 before that, was us supporting mining issuers through tough times. But again, as Chad and Atul talk about alternative investments as a hedge to inflation, and I think gold is the number one asset class talked about when you talk about hedging. So there's no question that our industry is going to see an influx of investment, and we're seeing that already. Flow through is a really nice thin edge of the wedge. If you're not comfortable making a resource investment just yet, having the tax incentive to do so really goes and gets guys comfortable with that investment, and we feel that goes and drives them towards investments that are not flow through based, because you don't have to just make flow through investments in the mining sector. Obviously, uranium has been very hot, lithium has been very hot. The whole change to EVs has been a massive influx. The amount of copper that you're going to need in order, not just for the cars, but for the actual infrastructure, because you're literally making gas stations that need to go and house power versus gas. So there's going to be a need for all these things, and we think that it's a really good place to put your money.
Great. Excellent. Well, thank you. I think, if I may, what you're basically saying, again, as we've talked about these other investments, and we're not here as the chamber to recommend anything, but they are alternatives. They're a complement to your overall portfolio. And as to your point, there is a place for them. And again, it's cyclical, but the government has been supporting this for a variety of good reasons over the many years. And again, although there's often noise, it will more than likely continue to do so as we go forward. So thank you for that. Atul, I'd like to ask you, something that Sebastian just talked about a little bit about is, again, investments that are, again, non-correlated, and again, gold, he mentioned gold. I'd like to talk about like wine, and we know about lots of non-correlated gold. Recently, I read running shoes. We've heard about NFTs now. These are other asset classes, which I personally believe there's a place for all these. If I may ask you though, about wine specifically, how big is this market? mean, can it continue to grow, and support, your expansion plans and for opportunity for investors to grow with it?
Right. Yeah, Oded. Obviously, we think so. And as Sebastian and Chad have talked about, from their investments, both being, hedges against inflation, wine is very much like that, as well as a real asset. And so real estate, minerals, gold, wine, other real assets tend to do well in inflationary periods as well, given their absolute return profile. So that's all positive. In terms of the market, as I mentioned, there's about 4.5 billion of new investment grade wine vintages coming on every year. And we'd estimate there's probably about 7 billion globally in secondary trading of these fine wines every year. And we're the leaders around the world with about 340 million in assets. So we think there's still a lot of room for us personally to continue growing. And what we're really excited about is that we're approaching the entire space as an ecosystem. So right from developing stronger relationships with producers, straight through to the tools in our website. And we've got some other plans that maybe next time we're on, we can talk about.
Okay.
Suffice it to say, what we're doing is we're increasing the number of participants in the fine wine space. And so we think that by continuing to educate people on the merits of fine wine, will bring in more participants and therefore more liquidity into the space of fine wine. So yeah, we've set a target of taking our assets to about 1.5 billion over the next 5 years. And given the scope of the US market in particular, and the fact that nobody's really done this to any large degree down there, we think that there's a pretty big opportunity to really grow the North American space, and it's untapped right now.
Thank you. That's amazing. And as you alluded to, the larger the market is, the more liquidity it creates, which is great for everybody. I think that's a great point. Thank you. Chad, if I can come back to you really quickly, something that is probably on everybody's radar right now, as we've heard, the Bank of Canada or the Fed, rates are starting to climb back up. Maybe talk a little bit, maybe perhaps give your general thoughts on that, and how do you see that impacting specifically Align Capital and the product that you offer people?
Oh, thank you very much, Oded. Great question. It comes up, you're right, all the time. One of the benefits of private lending is we're short-term solutions. So most of our mortgages you saw are 1 to 2 years. At the outside, it's 2 years. Most people, it's less than a year. And the interest rates are always reset as each deal comes up. So as the rates rise, the private lending rates will also rise. There's that margin that's there. So in effect, we're almost interest rate neutral. And I feel as rates rise in general, it puts more fuel to the fire for people to pay attention, get rid of high interest debt, refinance, leverage their properties, and do those type of things. So as rates rise, it's actually a good thing for us.
And while I got you on, maybe, or Adam, please comment, please add something.
Yeah, I want to add something to that as well. In your regular portfolios, your bond portfolio, your preferred share portfolio, as interest rate rises, of course, the inverse relationship is going to drive the values down. That doesn't happen with a private mortgage entity. The interest rate goes up, but our value stays stable. So it's a very good hedge against rising interest rates.
That's great. Thank you, Adam. While I've got you both here, maybe one last comment. Perhaps, again, you're not economists, but how do you see interest rates moving, in the next 12 to 18 months?
Well, actually, I am an economist by training, and
okay,
you knew that.
Well, again, I've forgotten. That's so far ago. We've already got. There's a couple lawyers on the call. Now we've got, like an economist. Too many.
Well, the big thing will be, how do the central banks feel about the inflationary pressures, and that'll be the big driver. And right. So it's always a question of when, rather than if. But it's a difficult question to answer. I don't know when they might raise rates. They've held steady so far. But I guess if inflation gets out to out of what they consider out of control, whatever that measurement is at the moment, that's when you'll see a rise in interest rates, and we'll benefit by them.
Right. Okay. Great. So you're not sharing what your crystal ball prognosis is with us. That's
No,
fine.
if I had a crystal ball, I'd be richer than Bill Gates,
There you
right?
go. Yeah, that's right. Chad, if I can, sorry, no, I apologize, not Chad. Sebastian, if I can come back to you, one other question. As I said, I've had some experience with flow through shares. Perhaps you can help out specifically with, with Red Cloud, and maybe differentiate between if there's single issue flow through shares, which I think you've effectively alluded to, or is there the opportunity perhaps with Red Cloud or for investors, if they're not sure that they want to go into one, to look at a fund and a group of investments?
Sure. So there's a bunch of flow through funds that are out there, and they end up deploying capital largely with us. So that they buy a basket of our goods rather than, I guess, an individual going and picking and choosing one stock that they like the most and hoping that that's the one that holds steady until the whole period comes off. Yeah. So there's 3 or 4. I mean, there's Maple Leaf. There's Middlefield. There's a whole bunch of different funds that you can get into if you want to go and invest that way. There's also, if you talk to your tax planner in general, the PwCs of the world, they go and they have a flow through investment where basically they strip the tax out of it immediately. So you don't even have to hold the investment. They'll find a back end buyer that'll buy the stock and want to hold the stock, and you'll just strip the tax savings out of it and be able to go and roll that over multiple times. So some people don't want to hold paper in their portfolio. They just want to go and make sure that they're giving a little bit less to the tax man than they thought they were going to, versus try to go and make it net zero. So there are multiple avenues. And again, myself or my team is more than happy to speak to anybody on this call on an individual basis. We're not offering any advice on the call right now. Everybody's portfolio is on an individual basis, and we're happy to have those discussions should the time come.
That's great. Thank you. Yeah. So again, as you said, I guess what you're saying is there's options for people, whether it's to look at, as we said, single, and we can provide everybody your information should they want to speak to you directly after. So that's great.
Yeah. Some funds are better than others. Some portfolio managers are better than others.
Right.
As you know, I mean, I'm sure that on the wine side, you can probably say the same thing. I actually like the commentary between Adam and Atul here, where I'm trying to go and figure out, how do I go and protect my mortgage rate? Well, maybe it's investing on the mortgage side in order to protect my rate potentially going up over time. And the same thing, how do I protect my wine habit? Maybe that's by going and making an investment in wine. I'm just trying to go and figure out how I get 1 or 2 bottles out of each of the cases that I invest in.
There you go. Well, I'll give you Atul's number after, and you can connect with him, because maybe investing is maybe better for my liver than drinking. So as opposed to Atul, I would like to ask you one question. Another thing I mentioned to Adam, I mean, we know about interest rates, and to Chad. I mean, the other thing that's going on in the world today, obviously, is more recognition and of what we're doing to the world, the environment, ESG. Maybe can you talk, just maybe in generalities, if climate change is affecting wine, which I expect intuitively it is, but also, and how you see all that playing out. I mean, the ESG flow, towards investments.
Right. Yeah. I'll maybe answer that from 2 perspectives. One is from our corporate perspective, where we actually conducted an audit and have purchased offsets, so that as a company, we're actually carbon neutral plus as a result of having invested in some great initiatives in Africa and Asia, as well as some reforestation projects. So as a corporate entity, we're very aware of our footprint. In terms of the wine world as a whole, climate change has been a big issue, and because it, at the heart of all of this, wine is an agricultural product, right? It's growing some good grapes and fermenting them so that they taste good. But as any other sort of agricultural endeavor, you're subject to Mother Nature, and as we saw this year with frosts early in the season in France, wildfires on the West Coast, California and British Columbia, floods in Germany. All of these events have impacted the supply of wine for the 2021 vintage to the degree where in France, many wines are going to be down 50 to 60% because the grapes didn't make it through the frosts. And so climate change is a real issue. And what we're finding is that in certain regions, the warmer climate is benefiting them. And in others, because of the variability of the weather, it's actually detracting from their quality as well as their production. This is important because when we meet as an investment committee, which we do quarterly, and go through our quantitative analysis as well as qualitative and macroeconomic, we consider the climate obviously in reviewing how we think that the value and quality of certain regions and vintages are going to be for that year. So it's an important factor when we take that into our investment analysis as well.
Great. Thank you. Yeah. Well, I think I've covered most of the questions that have come from the audience, and we can open it up if there's anyone of our panelists who would like to, if they have any questions for the other party, or if there's any closing remarks. From my perspective, I mean, I thank you all of you for attending. I think it's been wonderful. I think we've learned a lot just in the last 50 minutes. They're all alternative investments. They all have unique opportunities. For any one of our people who attended this conference, please, if you have any questions, we can get you directly in touch with Atul and Carrie, Sebastian, or Adam and Chad for the specific investments. For those of you who don't know, I think the flow through shares concept is very timely now. I mean, we're coming up to the end of individuals' tax year. So that's something that is I don't want to say of urgency for anyone. If anyone's interested, they should reach out quickly. As far from a wine and real estate, both Atul and Chad have commented. I mean, they're growing their business, and there's more and more opportunity. And I think it's wonderful what you guys are doing. I want to thank all of our guest speakers, as I mentioned, Atul, Carrie, who didn't speak but is a chief marketing officer, with Cult Wines, Sebastian from Red Cloud, and Chad and Adam from Align Capital. Thank you all of you. It's been wonderful. For all the people on the call, on behalf of the Canada Chamber of Commerce, a belated happy Hanukkah to everybody, and also a Merry Christmas season's greetings to everybody, our panelists as well as our speakers. Wishing you all a happy, healthy season. We are looking forward to having our next event in January. We're also looking forward to having all our guest speakers back at some point. Thrilled with the people with their participation and all the people who attended today. So I tend to talk a lot. I'm going to turn it. Is there anybody who would like to do any closing remarks from any of you? But again, I just want to say thank you one more time for all of you in participating today. Nothing. Again, that's great. Then I'm going to leave it at that and wish again everybody a season's greetings. Thank you all, and look forward to speaking to all of you in the very near future.
Thank you, and
bye, everybody.
Best of the season to everyone.
Thank you
very much, everybody.
Bye now.